Time now for the word on Wall Street. Top investors watching your money. Joining me now, Citi head of U.S. equity trading strategy, Stuart Kaiser, and 248 Ventures chief investment strategist, Lindsey Bell. Good morning to both of you, Stuart. We're going to start with you, taking a look at futures. We're actually moving just a little bit higher now with the Dow up by 55. We did have a pullback yesterday. We had Intel dragging down markets, Nvidia and Apple. Bit of an AI momentum change as we're seeing that slow down. Investors are watching the Middle East. There's certainly doubts growing about the reopening of the Strait of Hormuz that's affecting oil. We are watching oil, as you can see on your screen right now, actually coming just a little bit down. We started out the session a little bit higher, but we're pulling back now. Tehran claiming that they're close to a deal with Oman to direct traffic in the Strait, while further resisting direct negotiations with the U.S. Global oil inventories under pressure. The SPR falling to under 300 million barrels. We haven't seen, Stuart, that level since 1983. So talk about kind of that macro story right now for the markets.
Yeah, look, I think from an equity perspective, you're probably focusing most on the price of gasoline, to be completely honest with you. National gas price is about $4 a gallon. Equity markets seem to have, become okay with that kind of level. If you go back to February, March, there was all this discussion about oil being $120, $150, and that, pushing gas prices well into the $5 range. And I think the fact that that hasn't happened, and you've had earnings come in very strong alongside that, has gotten equity markets basically saying, come to me when oil is 90, and then I'll start worrying about it. But I think until we get that kind of dislocation, equity markets seem to be pretty comfortable focusing on the AI CapEx spending cycle and what that's doing to earnings.
Yeah, I think the only concern with oil is the SPR, but which is why I brought that issue up. But also, the other question mark that we might get and started seeing some of the data is going to be whether you're going to get supply chain inflation. Lindsey, I want to look at Intel with you because they raised their stock offering to $20 billion this morning. Yesterday, they announced plans for a $15 billion offering. They want to fund AI spending with the money. The chip maker slid 4% yesterday. The stock is down 1.25% today. This is the first public share sale since Intel went public back in 1971. We should also say that the U.S. government does have a stake in Intel. Your thoughts?
Yeah, it's interesting to see Intel taking advantage of the rise in their stock price to fund their AI strategies here. And yes, the stock is sliding. Of course, when you issue equity, equity investors don't love that. But the stock is still up substantially on a year-to-date basis. So I think this is just an example of it's not just debt financing. A lot of the hyperscalers are getting, scrutinized for the debt financing that they're doing to fund the AI build out, but you have equity financing. You also have vendor financing. There's a lot of different ways private capital is now coming into the market, as we saw with Nvidia, to support this AI build out. So there's definitely a lot going on here. You could theoretically say that it spreads the risk across different asset classes, but still at the end of the day, there's a significant investment going into the AI CapEx build out.
Right. Well, let's stay with AI because Nvidia is now teaming up with Wall Street giants for $500 billion in financing for new AI infrastructure. Firms like Apollo Global, Blackstone, BlackRock, Brookfield, Goldman Sachs, KKR, they are all part of this deal, and this provides access to computer power for the company's largest customers. Stuart, I wanted to get your reaction to that.
Yeah, look, I think what the market is telling you is that, they believe that there is a significant return on invested capital that's behind this CapEx spending cycle. And that was the big question coming into this earnings season was how much are they going to spend and can they show us that this is actually a good investment? And most of the companies, our research team believes they're basically borrowing at 6% and earning almost 30%. So if you're borrowing at 6 and earning 30, you're going to get a lot of the biggest investors on Wall Street that want to be part of that investment. So I think that was probably the biggest positive coming out of earnings over the last couple of weeks was these large companies, A, saying they're going to spend, but B, more importantly, attaching a return on that spending that's attractive enough to bring more capital into the space.
Yeah, and Lindsey, Nvidia is going to report on August 26th, and one of the last companies to report, but you could argue maybe the biggest company to report for the second quarter.
Yeah, no, absolutely. All eyes are going to be on Nvidia's reports. The semiconductor stocks have come under pressure as of late, as the hyperscalers, though interestingly, like Stuart had just said, they're showing accelerating revenue growth and margin expansion. So investors are feeling better about the capex spend. It's becoming much more justified. The question is, what inning are we in this AI capex build out, and the confidence that the market is showing that these financial institutions are showing by raising this type of capital to put to work suggests that we're really in early innings. And I mean, if you really think about the use cases for AI, they've been limited and there has been slow adoption. So that suggests that there's more room to run. On the other side, you are seeing credit spreads for hyperscalers or the high yielding data centers and neo clouds starting to widen, not at any scary levels or concerning levels at this point in time, but it's something to watch for sure. And there's a lot of excitement in this space, but we can't ignore the risks either.
Yeah, and that was why there was a headline in the Journal yesterday that was pretty eye-popping about the concerns in the private credit world, and it's all, unfortunately tied together. Real quick before you both go, home sales within 5 miles of these large data centers reportedly more than doubling since 2018. This makes up roughly 1.5% of all home sales. Realtor.com reports that number is going to rise to 2% by the end of next year, but they note the expansion is happening in lower income communities, and this puts home prices rising. So, look, if you're going in to buy one of these homes, Lindsey, that's certainly an issue. The other is the transformation that these communities are having because of data centers coming to them.
Yeah, I mean, I think it adds to the backlash that you're starting to see from the communities where these data centers are being built. And you've seen, the politicians get involved in this in states like Texas and New York. So I think that this is just the beginning. Obviously, we need a lot of land and a lot of space to build massive data centers, and the housing market will be impacted. But the housing market has been, in general, I know you got Mitch there. He's the expert on this. The housing market's been pretty frozen over the last year or so, and of course mortgage rates are increasing. You're seeing prices still at elevated levels, so I don't think that's going to change anytime soon.
All right, Lindsey Bell, Stuart Kaiser, thanks to you both for being with me. Really appreciate it this morning. We'll be right back, everybody.